Okay, good morning, welcome to class. We'll attempt to go over our trades that we've taken today and over a couple of more trades, and let's see how we'll go from there. Today is Thursday. Of course, now we didn't have class in the group today, but we had a couple of signals given to our guys. Okay, but before we go there, can we know your name and where you're joining us from? Your name and where you're joining us from? Hey, Fatai, welcome. Binam, welcome. Email Okon, welcome. Alright, so quickly, on GU, of course, now we already give a signal, a buy signal from here to here. But looking at this right now, it's not go that far. What will happen is that markets will go into this zone, touch and go up into this zone, then continue the rally down. Okay, so in case you're expecting a long, in case you're expecting a long buy, once it gets to that zone, you might want to consider closing or something. That's for G. All right, but how many of us got the sell in the morning? How many of us got the sell in the morning? All right, so that's what we're expecting on G. A move into the zone and then down. On G card might just do the same thing. If you look at it, you see that it has broken this structure here. We have a market structure shift here. All right, so anything you're expecting right now, all right, if in case you're expecting a buy, it might not really play out. The next zone that we're taking a sell will be from here, from this other block here. Next one I'm expecting a sell maybe from this other block here, so you might want to watch out. All right, so market is still in a downward trend going in that direction, so every intention to buy right now might not really be the best. That is on G card. On BPSZ, okay, nothing is there. GA, of course, you guys remember this GA that we gave the last time that we were here. That was on Monday. Last time we were here on Monday, you would have seen that we gave this buy from here that I was explaining order flow. I was explaining order flow from here. You have seen this buy. You have seen this buy when we explain order flow. If there's something you want us to talk about, please, this is the time. There's something you want us to talk about. If there's something you want us to discuss, this is the time. Bring out your I say bring out let's know in the comment section. Do you want us to discuss anything? You want us to cheat something? Let us know in the comment section. This is the time. I want to join you. Okay, what time are you on? Seriously, I'm not answer for you. Caleb, right now I'm on 2 hours time frame, but on GU I was on 15 minutes time frame. 8 shirts. EU signal B. Okay, EU signal is still going. EU signal is still going. Or that it might not have enough strength to push. Might not have enough strength to push because it has not really got into zone. But regardless, right? Regardless, we are going to have a little push up before we start going downwards. Alright, so I want to teach. Tell me what you want to learn. I want to teach, please. Tell me what you want to learn. Which strategies do you want to learn so that I can teach it? Which one is the one so I can teach it? I'm available to teach today. I'm available to teach today. Which studies would you like to learn? Multiple time frame market structure. Multiple time frame market structure. Okay, how to identify multiple time frame market structure? Liquidity. Okay, let's start from multiple time frame market structure, then we'll enter liquidity. Alright, we'll start from multiple time frame market structure, then we'll go to liquidity. I'll be fast with these things so that we can go to the next one. Okay, multiple time frame market structure is simply the technique to look at the markets from a higher perspective to a lower perspective. All right, now it is important to know that every time frame that you go on from the highest point, right, it makes you see everything. Now get this, if you are on higher time frame, it makes you see everything. It makes you see wider on higher time frame. It makes you see wider, but when you come to the lowest time frame, it makes you pick up a single thing. This is what I mean. In higher time frame analysis, it makes you pick up everything, but in lower time frame analysis, it makes you pick up a single thing. This is to say that in higher time frame analysis, you use it to see where the market is going to, but in lower time frame analysis, you use it to enter the market and follow the market to where it is going to. Do you get what I just said? My link is on my bio on YouTube. You can just send us a message. My link is on my bio on YouTube. Just send us a message. Join the group. Now, like I said, higher time frame tells you where the market is going to, all right, and the lower time frame helps you join that move and go to where the market is going to. I like giving an example of the world system with higher time frame. If you are from the space now and you look down, probably you see the whole world. You see Earth. If you're on space and you look down, you see Earth. All right, that is higher time frame analysis. We can say that one is one month time frame, or we can say that one is 1 week time frame. You are from up, you look at Earth, that is 1 month time frame, 1 week time frame. Now if you want to see further, you've seen the whole Earth. If you want to see further, you can now start going down from 1 week time frame. You can say, okay, I've seen the Earth, now let me now pick out Africa. Get my point? I've seen the Earth, let me now pick out Africa. You now have to go down from that 1 week time frame to 1 day time frame. Now when you get to 1 day time frame, you can now see Africa. That is in 1 day time frame. You are in Africa and you want to say, okay, I want to see Nigeria. From that 1 week time frame, from that 1 day time frame, I want to see Nigeria. So if you want to see Nigeria, you have to go down again to 4 hours time frame. Now in 4 hours time frame, you can see Nigeria. When you are in 4 hours time frame, you can now say, okay, I've seen Nigeria in 4 hours time frame. Now I want to see Lagos. You now go to 1 hour time frame in Lagos. You see how we started going down from the Earth to Africa to Lagos. So from the Earth to Africa to Nigeria down to Lagos in 1 hour. You now say, okay, I'm in Lagos. I want to see the capital of Lagos. You can now go down to 15 minutes or 30 minutes time frame to see Ikeja. You see how I narrowed it down. That is the bit for higher time frame. Now attempt to do it in this place now. Now this is one day. This is, let me start from one week time frame when we're in Earth. Let me start from 1 week time frame when we're in Earth. Okay. Now we're in Earth 1 week time frame. This is Earth in 1 week time frame. All right. Want to see, okay, right now this is Earth. What can we see further? All right. In Earth, this is what we can see. What can we see more? We can now go to 4 hours time frame. 4 hours time frame will now tell you that, okay, we're actually on this big move. Now on the one week time frame, this was one move and this was another move. All right. But you also see that there's small moves inside. I like to think about it again as per a move like this. You can see a move like this on higher time frame, but if you now go down to lower time frame, you now see what makes up this move: the impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective. It is inside all this move, but if it goes to lower time frame, you can only see it. Now look at this thing I've drawn. you look at how it is going up down up down up down, but in higher time frame if you go to one day you only see a big impulsive move. Did you see it? You see that it's a big impulsive move. So if you go to lower time frame you see it clearly. Now let's go to lower time frames. You now see that okay, from here market is giving us impulsive corrective, impulsive corrective, impulsive corrective. All right, even though it's inside that one day time frame, you can still see that it has been corrective and impulsive. So another example that I like to look at is that in a structure like this, in a swing move like this, let's say this is one day time frame. Inside that one day time frame you see small moves, small moves inside, small moves inside. So how you want to do is that from the higher time frame, once you see the move, you can now go to lower time frame to understand how you can catch this move and follow it to this point. That is what lower time frame and higher time frame means. I don't know if you understand what I should explain again. Please, do you understand what I should explain again? Guys, do you understand? If you understand, drop 1. If you don't understand, drop 2. If you understand, drop 1. If you don't understand, drop 2. If you have more questions, type your questions. Caleb said 1. Musa said 1. Fatai said 1. Sad said 1. Benga says 1. Okay, so everybody understands. Binam does not understand 2. Okay, so since more people understand, because of time, let's move on. What is liquidity? What is liquidity? All right. The next question that came up when we started this class is liquidity. What is liquidity? So let's go to liquidity. I'm currently formulating a strategy, right? Once it's ready, I'll let you know. What is liquidity? My volume is low. Is the volume better now? Is the volume better now? Guys, is the volume better now? Alright, what is liquidity? Now, simply, if you look at this, what I used to tell my students is that liquidity simply means fuel for the market. Liquidity simply means that the market is liquid. Liquidity means simply the order flow of money, all right, from the traders who fuck up less. Listen to this. Liquidity is simply transfer of money from the trader who fuck up more to the traders who fuck up less. Did you catch that? Did you catch that? It means that at this point right here, what we were taught when we were starting Forex is that whenever you see equal highs or equal lows, you want to do what? You want to sell from there or buy from there. That's what we were taught. That's what we were taught. We want to sell from there or buy from there. That is what we were taught. So a normal trader, once market gets to this point, they're waiting for market to do what? They're waiting for market to enter this zone. and then once market go back to this zone, they will want to start selling, which is very, very, very wrong. What happens is that market moves in two ways. Market moves in impulsive and corrective moves. This is what we call higher highs and higher lows. This is what we call what? Higher highs and higher lows. Now, if the market, if it has been established, Sal is saying no. Mr. Sal, you're saying no. Does anyone have a question before I move on? Does anybody have a question before I move on? Okay, Okon has a question. Please go ahead. Okon has a question. Please go ahead. Is bad the volume? The volume is still bad, Abi. Is it better now? Okay. Now, liquidity simply means trap for the market. All right. It is a point where the sellers or the buyers get liquidated. Now, I don't know whether you've been on any trade before. All right, you've been on any trade. Probably wanted to sell from this point. Wanted to sell from this point here. Wanted to sell from this blue box here. So what market now does is that market now goes in your favor, goes like this, gets to your blue point, now does as if you want to start coming down, but ultimately goes up, take your SL, and then start coming impulsively into your direction. Now, a good proof that you have been liquidated is that market will now leave your zone impulsively. After taking your SL, it will now start going in your direction impulsively. That is a good definition that you have been liquidated. It is a good evidence that you have been liquidated, because it means that not just you, we are not the only one waiting for that sell. We are not the only one waiting for that particular sell or that particular buy from that point, right? Let me show you something. This is a very good example of liquidity. Now look at this. A normal trader wants to say, okay, this is a high now, I'll sell when market gets here. Let's turn this to 15 minutes time. A normal trader will say, okay, this is a high now, I'll sell when market gets here. Why? Because he can see what? He can see higher highs. You can see all this line here, so he has agreed that he will sell from there. All right, he has agreed in his mind that he will sell from there. Now market knows where your stop loss is. Understand this. Market knows where your stop loss is. All right, so eventually you now said, okay, I'll start selling here. What market will now do is that market will get to your favor. Look at this here. Market will get to your zone, start coming down little by little, then go up, take you out, like I explained. Go up, take you out, and then start moving impulsively into your zone. That is a very good indication that you have been liquidated. All right, because you saw equal highs here, you now wanted to start selling from that point. That's a very good this thing that you have been liquidated. Look at this equal highs. You would think that when market returns back to this one, what's happened? It will go down. Guess what? It actually went down a bit, and then guess what? You now think that you are in profit. You now start stacking impulsively, stacking. What now happens? Market now comes down, goes back up, takes out your SL, right? Takes out your, because your SL would have been here. Take out your SL and push. Now look at how market will go now. Market will also take out all the SL that people were expecting. Take out all the SL that people were expecting, and then start pushing. Look at how market will go. You see, take out all the SL. You can see the SL that is taken out, After market has taken all the SL from there, even though your SL was 10 pips or 20 pips or 5 pips, market to take away all the SL. After market finish taking all the SL, market now start moving into your desired direction. That is simply the liquidity. Now there is a concept that is close to liquidity, which means inducement. Now the I always get questions about what is liquidity and what is inducement. Liquidity is that market will actually touch your zone. This is a buy. Liquidity is that market will actually come and touch your zone. That's liquidity. It will touch your zone and pass it. To touch your zone like this. It will actually touch your zone like this and pass it before it starts going up. Before it starts going up like this. Alright, but inducement, right? Inducement can do two things. Inducement can now get to this point, almost touch your zone, then start pushing up. Now this gives an impression that market has touched your zone and you are now on the upward trend. You see that liquidity touched your zone and went down lower, but inducement would pretend as if it has almost touched your zone, right? After it has almost touched your zone, it will now start going in your direction. You will now be happy and add more lot size. You will now be happy and add more lot size. After that, after it goes small, to now come back down, take away your SL and then push up. That is the difference between inducement and liquidity. Do you have questions? Do you have questions? Do you have questions, guys? Okay. So which other concepts do you want me to teach? Which other concepts do you want me to teach? Okay, I guess that's all. If that's all, tomorrow's class will be on YouTube. Tomorrow's class will be on YouTube. Tomorrow's class will be on YouTube. So do not be late on YouTube tomorrow. Do not be late. Tomorrow will be backtesting and strategies on YouTube by 9 a.m. So do not be late. Ladies and gentlemen, I'll talk to you guys in the morning tomorrow. Thank you for joining class today. By tomorrow 9 a.m. we'll meet. Have a blessed day ahead. Goodbye.